Hi everyone, my name is Rongren. I'm a fixed income portfolio manager with Eastspring Investments. And for those of you who are unaware, Eastspring Investments is actually a fully owned subsidiary of Prudential. And we actually manage assets in excess of 200 billion, which makes us one of the largest regional fixed income fund managers in Asia. So without further ado, I'm going to spend the next 15 to 20 minutes today actually sharing you, introducing to you ESG, as well as the underlying strategy, the Asia Fixed Income Fund, which actually applies ESG considerations in its investment framework. So as a quick start, maybe I'll just give you a short introduction as to what ESG is really about. I think we hear a lot about it. And I think the fact of the matter is it's very broad in nature, but what has been increasingly in focus over the last couple of years is related to the environmental part of ESG. It relates strongly to climate change. You know, the likes of Greta Thunberg actually making prognostications about the death of the Earth because of human activity, and of course water scarcity issues, floodings, adverse weather patterns. These are environmental issues that are tackled in ESG. And then, of course, something that we probably, if you are a seasoned investor, you will be well aware of, it relates to governance. It talks about how, you know, company management actually manages a company, how transparent they are to their investors, and how well they actually treat their employees. You know, all these things actually translate into actual company performance. So, you know, ESG is very broad. I could spend an entire day telling you about what ESG is really about, but I'm just covering, you know, what essentially is in focus or what is relevant when we actually apply ESG evaluation in our fixed income investment process. So at the end of the day, when we actually try to apply ESG considerations in fixed income, that means when we buy the bonds of a company, we actually want to evaluate the risk. Because, you know, when you buy a bond at par, after maturity, you expect to get your money back together with clipping the coupons. And, you know, the last thing you want is for a bond to default. That is when a company gets into trouble in the middle of you holding its debt and for reasons which were not identified earlier on. So what I'm trying to actually share with you here is that ESG risk is actually a real risk that may not necessarily be covered in the conventional financial analysis that is being done across the industry right now. So for example, you know, on the environmental front, we have seen the floods in Pakistan, as well as the droughts, as well as, some sort of flooding in select cities because of adverse weather changes. These are risk factors that we need to actually take into consideration in terms of where a company actually has its businesses actually running. On top of that, you know, in terms of governance, I think over the years you have seen how, you know, corporate governance issues related to the lack of transparency, such as Sino-Forest, or even more recently FTX, how money is being shifted around without proper controls. This actually results in major financial losses for the investors. So all these ESG risk factors that you actually see here on the chart, as well as what I've just described to you, it translates into consequences for companies. We need to find a way to have a structure in place to actually evaluate these risk factors, which are not in the conventional evaluation framework, so that we can actually assess its risk and whether the company is actually ready to tackle this risk before we actually buy their assets, be it their securities or their equities. And this is what ESG assessment is all about. So as we all know, 2022 has been an extremely challenging year. The financial markets have been beset with a lot of setbacks. First of all, you have your Fed hiking rates by close to 4% and then some, another 1 to 1.5% this year. You had the Russia-Ukraine crisis, which caused the energy prices to actually spike up. And we also had a lot of uncertainty on this uneven COVID-19 recovery. We just had China, you know, just reopening and suffering its first major bout of surge in cases, which has shut down, you know, major cities. So it's been a challenging year. And as you can see on the chart on the right, no asset class is actually spared from the challenging year that was 2022. Equities, bonds, all sold off in tandem. And this is why, you know, we advocate a flexible approach. a flexible way to invest. And that is what the total return strategy, that is the Asia Sustainable Bond, is about. That is, we actually take all these challenges as well as opportunities into consideration when we actually invest in the fixed income space in order to actually deliver the kind of return that we want to in our investment objectives, which is between 4 to 6% each year. And how we do it is, number one, as I mentioned, I think we are very risk focused. We evaluate the ESG risk factors which are not conventionally captured in your financial evaluation framework, number one. And number two, we actually try to limit excess volatility in such a portfolio by actually enforcing some parameters, right, that prevent this from happening. Like, for example, rates have been going up a lot, but this portfolio was not particularly hurt by it because we kept the tenors of the bonds that we actually bought, right, much shorter than what the average market is. The average tenor of the bonds in the market was around 7 to 8 years, but we just bought bonds that were in the 3 to 4 year bucket. So even as rates rise, right, our bonds, right, actually drew down, right, by a much lower amount. And then we do not just invest in, the just names, right, in all the benchmark universe. We actually explore opportunities. We look at both high yield, IG. We take into consideration the prevailing investment environment in determining whether we want to actually go more defensive, invest in the safer credits, or to actually go into something that probably can give us more potential upside. So for example, in 2022, we decided that it was going to be a challenging year. So the portfolio became a lot more IG focused. And as a result of that, we avoided a lot of the defaults, right, which a lot of other funds, fixed income funds, actually suffered. And last but not the least, we actually have not just investments in hard currency dollar bonds. We actually invest in local currency bonds as well. Some of these actually give a significantly higher pickup than your dollar bonds. For example, the IG bond in the dollar space gives you perhaps something to 4 to 5%, but something that in the Indonesia space actually gives something in the region of 7%. So these are the opportunities that we actually seek out in this particular fund, right, in order to deliver the strong returns over the market. So as example, in 2022, these are some of the things that we did. You can see between the red as well as the black line. The black line is the average duration, which is the tenor of bonds which an average fixed income fund probably will be buying, right, in this space in the course of 2022. For the red space, that's our Asia Sustainable Bond strategy. We actually significantly reduced the duration of our fund over this period. And this actually helped mitigate a lot of losses, right, in our fixed income fund. And at the same time, we did not compromise on the returns even as we actually reduced the tenor of the bonds that we actually bought. You can see from on the right side, the yield to maturity of our portfolio actually kept pace with the broader investment environment as rates rose. So you still can continue to capture, the yield opportunities available in the fixed income markets, even as, we reduce the risk appropriately, right, taking into consideration the market environment. And I think on this particular slide, what I'm trying to show you is, even as we invest in investment grade bonds, there is a white space. You have your very, very high quality space, your AAA or double A's. You're talking about the likes of Singapore government bonds. I think, we actually do a risk assessment of all these different bonds, and we see where the best opportunities lie. For example, in the BBB space, because the spreads have widened a lot this year, we decided to plow into it, and it has given us a good mix of good combination of good returns as well as a relative safety, because these are still investment grade, predominantly investment grade securities. Now, when I talk to you about ESG consideration, it's not something random that we do on every individual security that we actually buy. We actually adhere to a very strict framework, something that is easy to understand even to retail investors like yourself. So it's kind of similar to I'm sure I see a lot of parents here in the audience, how the PSLE scores, right, have been moderated from absolute score, be it 270, 280, to different bands instead. I think bands are a better way of actually understanding risk as well as preparedness. So the way we like to think about ESG risk is, if it's high, it means that there are material risks, right, that we need to take consideration. If it's low, it means that we probably are not so particularly concerned about the ESG risk profile of this particular company. Then when we look at the preparedness, we assess whether the company has controls, has frameworks, or has resources in place to actually address this risk. And this is how we come up with this matrix over here. Every single issuer in our investment universe is actually assessed. And those in the green space, which you actually see here in this matrix, right, are the ones with the good ESG scores. These are the ones, right, where the ESG profile shows that the company, right, is ready to deal with the risk that can potentially materially affect its performance. And of course, the ones in the pink and red space, right, is the ones that you want to avoid because it just shows that the company doesn't have proper processes or frameworks or resources in place, right, to actually address it. Like, for example, a company, for example, operating in a region where there's frequent flooding, but they don't have mitigating measures in place for that. I think this is probably a company that you do not want to buy because, you know, all it takes is one flood to actually wipe out its operations and potentially, right, lead the company, right, to actually go bankrupt or to run into serious financial difficulty. So, at the end of the day, the proof is the pudding. When I actually represent to you this matrix, what I can show here is that if you actually look on the left-hand side of this matrix, you can see that, you know, in terms of the ESG profile of our investment holdings in this particular fund is greatly skewed towards the green part. And that what this means is we consciously try to avoid the ones with poor ESG risk and preparedness scores. And I think this is very important because it ensures the integrity of your portfolio over the medium to long term. Ultimately, when you invest in a fixed income fund, right, I think this is something that you want to be very concerned about. You want to be able to sleep at night. You leave the worrying to us. We will evaluate all these ESG risk factors, right, that can actually affect the long-term performance of your bond portfolio. That's what the sustainable bond strategy is really about. And if you are not familiar with our framework, I will actually refer you to, you know, the scores provided by legitimate as well as authoritative external ESG score providers like MSCI. As you can see here in the dotted box, that is the ESG rating score of the portfolio which I manage, which is an A. And it's actually 2 to 3 notches above the BBB, which is the investment universe that we are in. So, after having said so much, I think what I really want to deliver to you is why do you want to invest in an ESG focused strategy? Number one, I think, as I mentioned to you before, we use a total return strategy, which gives us a very flexible approach towards investing. We can invest in different types of the fixed income space, right, to actually generate the desired return while trying to minimize the downside risk. We capture all the opportunities without being subject to the constraints imposed by, for example, benchmarks. Number two, I think with ESG investments, you really gives us an opportunity to actually identify investment opportunities way ahead of the market. Like, for example, 3 years ago, we started investing in renewables. That was before, you know, this whole transition story actually came about. So with that in mind, I think that, you know, a forward-looking strategy such as a sustainable bond fund, right, is really something that's essential, right, into your investment portfolio. And lastly, I think a lot of people get this misconception. When you invest in ESG, it means that, you know, you are impact investors, you are just trying to do good. That is not the case at all. We invest in the same investment universe, right, as the conventional bond funds. So you are not expected to actually compromise on any performance. In fact, what we have done, right, is with the ESG evaluation, we give you the additional enhanced return, right, from actually the angle of finding more opportunities and minimizing risk. And this is what it's all about. It's about actually enhancing performance when we actually do ESG evaluation. So the next few slides actually gives you a sense of, you know, how the sustainable bond strategy has done versus, you know, the same investable universe that we are invested in over the past 1.5 years. This is the red line, and it's very clear that, you know, over the last 1.5 years to 2 years, right, the sustainable bond fund, although it has suffered drawdowns in tandem with the fixed income market, it was significantly less than that of the equivalent Asian markets. And if we actually, and we are not, of course, we are not the only ESG focused fund strategy based in Asia. There are several of them as well. But what I can share with you is we are one of the first to actually launch an ESG focused strategy, and we are one of the best performing ones as well. As you can see from the red line over here, compared to the rest of our peers, the further left you go, it means the worse you are. And we are actually much further on the right. So it just shows that, you know, we are much better performing, right, than the rest. Ultimately, as investors, I think return performance, right, is one of the most important considerations. And the same applies. It's not just as a comparison against, you know, our ESG fund peers. If you compare it against other fixed income funds, right, we do much better as well. And no small part of it is because of our ESG lens. Okay, this is just an example of environmental pivots that we actually take. For example, you can see we have a strong, what you call home bias here. Singapore actually makes up a large part of our investment opportunity set. And one of the reasons is because, Singapore, as one of the most forward-looking economies, right, has invested a lot, both in terms of regulation as well as in terms of investments, right, into ESG-related initiatives. So it makes perfect sense for us to be parking our money here, because I think, in terms of realizing the returns from ESG investments, right, Singapore is actually one of the most well-placed investment opportunity sets right now amongst all the ASEAN as well as Asian economies. Okay, and then lastly, I think something that I need to emphasize to all of you here is there's no compromise in performance, which is why we are able to consistently deliver a 5% historical dividend payout to our investors in this fund. And I just want to remind you that 5% dividend payout doesn't mean that the returns is 5%. We have a running yield that is way in excess of 5%. At the moment, what we have here is something in the region of 7 to 8%. We distribute 5% to you, we keep the remaining, right, to actually grow the fund and deliver even better performance to you guys. So my message to you is that, we target a return that is higher than actually the dividend payout of 5%, which I would argue is actually quite generous if it's over a medium-term horizon. Lastly, just a final introduction to Eastspring Investments. We are not new to the game. We are a fully owned subsidiary of Prudential, which makes us a very strong asset manager. You can trust your money with us, and most importantly, we are also award-winning. We have the fixed income strategies that we run are some of the biggest and strongest in the region. So if you have any further interest in, our other suite of funds, or if you have any other questions related to ESG or to the sustainable bond strategy, which I actually run, you can actually run to us over at our booth, somewhere in the middle of this exhibition hall. My colleagues and myself, we are most happy to actually tell you more about the Eastspring Asia Sustainable Bond Fund. Okay, thanks a lot.